Hi guys, my name is Christof van Tonder. I'm a chartered accountant here in Luxembourg, and this presentation I'm going to do today is about derivatives and more precisely about options. So the only thing I see people here in Luxembourg more scared of scary clowns are booking options, futures, forward rate notes, all these types of wonderful instruments, and actually there's no need to be scared of them. They are just normal instruments, and if you understand the basic principles of an instrument and you completely understand it, there's no reason why you should fear it, because you will know how to book it. So yes, this is really the first thing to understand about any instrument you're going to be. If it's derivatives, just bonds, just shares, just stocks, merchandise, it's understanding the instrument. If you understood the principle of how the instrument is going to work, how it's functioning, there's no reason why you can't book it. That's really the main thing. If you have complicated instruments like convertible bonds and forward rate notes, I don't know, your imagination can run wild, but if you understood the basic principles, you're going to book everything correctly. So what I'm going to do now is just explain to you. So if we talk about an instrument and understanding an instrument, we need to dissect the instrument. So I'm going to concentrate today on call options. They're really plain vanilla type of derivative instruments. But if you understood this, you're going to understand the others as well. So the first question which you're going to ask yourself is, what is the purpose of the instrument? If you got the purpose, you can situate it into an accounting framework. Exactly. So sometimes people forget that if you don't, just take an example, you guys probably are used to booking shares, but you know just as I do that depending on the purpose of your shares, it's going to be long term, it's going to be held on the portfolio. In that case, you're going to book it differently. So this is the same principle. So the first question is you're going to ask yourself is, what is the purpose of this instrument I'm going to book? The second question, you're going to dive a little bit deeper now. So you're going to ask you, what are the inner workings of the instrument? And then going into these details, you're going to ask yourself, are there any time events triggering the instrument? You're going to ask yourself, how is the pricing work? And if I have understood how the pricing works, where can I get reference to this pricing? Is it the board decision? Is it the market easily available on let's say, not to promote any Bloomberg or Reuters or whatever reference? Is it even the bank, the brokerage? Find out where you can get the pricing. If you cannot find the pricing, you have to calculate it. And remember, guys, if you calculate instruments, it needs to have at the end of the day board approval or internal policy approval. So to keep yourself independent and objective in all circumstances. So what does this mean for options? For options, we need to know a couple of things in order for us to book them correctly. So what are we going to need? So what we definitely need to know is, for options, what is the type of instrument? That's the most important, but other factors are expiry date. What are the underlying assets or asset can be grouped. What is the strike price of the option? Are we writing the option or are we buying the option? And the number of contracts we are going to buy if we are buying. And very important, the price per contract. Without all this information, and I'm going to come back to it again, it's important to know what type of instrument if it's a call option, is it a put option, what is the type of instrument we are buying. So I've just prepared a small example for you guys. We're going to it's a plain vanilla call option. It's American type option, so executable at any time. So I have here, it's the underlying assets will be Microsoft shares. It will be a contract for each contract will represent 100 Microsoft shares. The current price at this date for Microsoft shares is around $185 per share. We're going to buy stock options, which has a strike expiry date. At the 16th of September 2022. Remember, this year is 2020. The strike price for these options will be $130, and the price per option is 66 calculated. It's actually the market price at the moment at this time, so it's $66.28 per share per contract. So we on this example, I'm going to buy 200. I got 2 contracts for 100 shares per contract, so it gives us a total 200 shares. So this means that we will have twice 100 times $66.28. This will be our cost, and remember, this will be our entry cost, and this is a very, very important number, because this is the number you are going to see in your balance sheet. So once we have got all this, we have all the information we need to book the option, and even correctly. So smooth sailing ahead for us now. So how is it going to look? Nothing easier. This, let's say, the US dollar euro conversion. Remember, you're booking these in euros. If you are booking it in another currency, there's nothing against that. You can do it. Just remember how to convert correctly, and remember using the valuation of your cost of your funds. In this case, it's going to be plain vanilla. We are keeping our accounts in euros. We are buying these shares from our euro account, and as you'll see in the example, so 56,000 US dollars are equivalent to 12,119 euros. So this will be our cost. We will see on the balance sheet. So what we are going to do, we're going to simply just debit our option account with the amount 12,119 euros, and we are going to credit our bank account 12,190 on the other side as well. So this will come from your trading account, your current account at your brokerage firm normally. So I'm going to show you the balance sheet. So if you look at the balance sheets, it's very peculiar, because as you will see before the trade, this is going to be a balance sheet, asset to asset movement. So we will actually see very little difference on the balance sheet. So before the balance sheet, we're going to have 12,119 euros on cash equivalent on our current trading account, and after the trade, we can just have the options for 12,119 euros on our accounts. So important, there is at this stage no P&L movement. Remember, we use the commission, we can incorporate it into the purchase price. So this is the classical booking entry for an option. And then the second phase we're going to look at is, I'm not going to show a booking example of this, is plain vanilla. It's just standard booking for this. But I'm going to explain to you how the two methods we can use in LuxGAAP for valuation. So the main general rule is historical costs we're going to use. So this is standard unrealized losses are recognized at the end of the year, if we still got it in our balance sheet, and realized gains are recognized at the moment of their realization. So this is the classical historical cost model we are going to use normally. We have an exception we can use for hedging. So hedging is a bit more interesting. So what is going to be the effect of hedging? If we're using these derivatives as hedging instruments, we have to remember we have to link these to the hedged asset or liability, so as not to distort the balance sheet. So we're going to end up, if we're going to hedge an instrument, so we will not recognize the unrealized gains, but we are lost. So we want to keep these two instruments linked to each other so that we can clearly see, because in standard hedging instruments, we are going to compensate the loss of the asset with the gain in the value of the hedging instrument, so that it should in principle always stay the same. So it's important to link this. This is, however, an option in LuxGAAP. It doesn't necessarily have to be like that. Personally, I'm a great fan of this because it gives you a much more realistic view of how this should work on the balance sheet, and gives it's very clear, then understandable to anybody opening accounts and looking at it, and it's not going to distort your profit and loss account, which is very important. And then if we are using the second method, meaning the fair market value method, we are referring to Article 64 bis of the Luxembourg accounting law. So if you want to look up more, download the consolidated accounting law, and they're readily available and on the websites of many prestigious Luxembourg law firms, as well as on the websites of some of the big four audit firms. So freely available, transparent, so you can have a look at that. So if you're using the fair market value valuation method, there are rules when you can apply them. If those rules are satisfied, you can book the unrealized gains and loss to the P&L or to the revaluation reserve. It's optional. You can choose any one of those. But remember, once you've chosen a method, it should be always that method you are using. And for more information, you can also refer to Article 64 ter of the Luxembourg accounting law for more information. So this is it for my side on booking options. So if you understood this exercise for call options when you're buying a call option, and you take it further, you will understand it's exactly the same type of mechanism and principle you're going to use for put options. And if you're writing or buying, just remember always to understand the instrument. Once you've got the instrument, no worries, you will survive. And once again, thank you for watching. I'm Christof van Tonder, a certified public chartered accountant here in Luxembourg. And if you have any suggestions or any thoughts you want to share with me, my email address is here. So just drop me an email. I do reply, sometimes a bit with a small delay. I am quite busy, but I always take some time to reply, and I read my emails. Thank you very much.